Let's bring in Rob Thummel, who is a portfolio manager at Tortoise Capital Advisors. They have $16 billion in assets under management. Great to have you on the programme, Rob. Thanks for coming in from the US to speak to us this morning. Let's start by asking your sort of short-term expectations around OPEC. We were carrying a story here at Bloomberg yesterday around Russia and whether they were going to go along with the OPEC plan to extend production cuts. Is that your expectation? Do you think production cuts get extended past the deadline?
Yeah, we sure do. So Mohammed bin Salman in Saudi Arabia and Vladimir Putin from Russia have both endorsed a production cut, an extension of that production cut agreement through the end of 2018. We think that's important because if you look at the global oil inventory surplus, it's declined, but it still has a ways to go. So if we extend the production cut basically through the end of 2018, that surplus goes away, and we've got an environment where we have a balanced market, and oil prices will probably respond positively to that.
You think that's not all entirely priced in already? You still think there's room to go higher if we get an extension?
Yeah, absolutely. I think you're right, and I think that, and then we've also got a really geopolitical risk that's really come back to the oil price, right? So you've got issues with Kurdistan referendum, right? You've got Iranian sanctions that potentially could come back online. We've got a situation in Venezuela where you have a humanitarian crisis, right? So that could endanger some supply that potentially pushes oil prices even higher.
Matt.
What about the dangers to the demand side, Rob? I mean, here in Germany, all of the German automakers, which were content making diesels for the rest of their lives, all of a sudden want to make electric cars, this year. Is it going to change the demand side, the fact that it looks like we're pulling this sort of sustainable energy automotion forward?
Yeah, no, you make a very good point, Matt, and that's something that we watch every day and analyze every single day. But if you look at what's happened in demand, demand response to low oil prices has been very strong. Global demand for oil has probably been up 40 or 50% higher than what it's been normally, right? So this year we're going to grow oil demand globally by probably 1.6, 1.7 million barrels a day. That's 60 or 70% higher than the normal demand that you usually see of about 1 million barrels a day. So low oil prices, low energy prices actually have spurred demand even higher. So we still see that happening. If you look at all the forecasts, the short-term forecasts over the next 5 years, you continue to see oil demand growing globally every single year. And the U.S. is going to be an important supplier of crude oil going forward.
So if you see, Rob, the supply sort of in danger, demand continuing strong, and the price having a lot more room to move up, what's the best way to invest in that? I mean, do you just buy oil? Do you buy the producers? Where do you look for the best value?
No, very good point, Matt. So especially in the U.S., what you've seen is oil prices are positive for the year, but a lot of oil producers in the U.S. have not traded up with oil, right? So there's a catch-up trade here that's a possibility. So you can buy a bunch of U.S. oil producers that are still negative returns for the year and wait for them to catch up with the positive returns in oil prices. So, you want to buy high-quality oil producers like a Pioneer Natural Resources or an EOG Resources. They operate some of the best assets in the best locations in the U.S. shale basins. And have low debt, run by great management teams. Those probably offer the best opportunities for investors.
I was going to ask you about debt levels because there's a lot of people talking about junk bonds and a lot of people talking about distressed corporate debt in the United States, and the oil story sometimes crops up in that conversation. But Rob, talking about the broader equities picture just briefly, I've got here the 30-day correlation between the S&P 500 and oil. It's at a 7-month high. When oil goes higher, stocks are in the mood to go higher. Is that because this oil is being seen at the moment as a growth proxy?
Yeah, I think so. I think if you look at what has low energy prices done, right? U.S. shale has helped contribute to just low energy prices, not just in the U.S., but around the world. And that's been a great thing for economies, we think. And so you've seen, like I was mentioning to Matt, global demand for oil actually increase every single year, higher than what it normally grows, right? So that's a good indication that consumer demand is pretty strong. Economies are strong. And so we think that is a good indication of where we're going, and the global economies are healthy and strong because of low energy prices.